Good morning, everybody. Welcome to the Morning Volatility Report. It is I, Andrew Giovinazzi, Chief Operating Officer of OptionFit.com, back from my 1-week Chicago trip with Mark. If you catch our trade idea of the week, he had some long SPY calls on Friday. And we had a nice little rally here today, so not a bad call. The big thing really is, and I have to say, let's just make it simple. There was a lot of expectation maybe for at least vol coming down after the Fed announcement. We certainly had that for a while last week, and then I think we proceeded to give back 3%. Vol went up. Here's the SPY. It's coming off a little bit, and at this point right now, I'll make it easy. I am actually in a total no man's land about where market volatility is going to go. I thought we would see something definitive, and right now, the only wild card obviously was how the markets respond to the Fed going to the raising rate regime. Who knows what's going to happen? They gave some guidance. Maybe they talk it down a little bit as time goes on. But other than that, I think let's just say the put provided by the Fed seems to be a little less within everybody's grasp, to make it simple. And as of right now, we have a 19 VIX because stocks are moving. Let's again, we weren't moving a lot, and now all of a sudden we are starting to move a lot again. And really, I don't think without a whole lot of rhyme or reason, except just oil prices. We did have a touch of that high yield bond scare a couple of weeks ago. All of those things, the euro's continuing to actually strengthen versus the dollar. Just a lot of what we'll just call adverse things. We raise rates, the euro rallies. So you're not getting a lot of the movement that we thought we might get. So at this point, with volatility here, it looks at least slightly. I mean, you got 10-day volatility is 19%. The VIX is 19.5. Okay, so just if you're going to go by the general yardstick, there is enough uncertainty to go around. We're staying at a higher rate of volatility, and at least, I guess, short term, that's what we have. I think the biggest problem is commodity prices. So just stocks that we look at, obviously oil, trading at multi-year lows now. Stocks like FCX, savvy investors kind of jumped in and started buying some of that stuff. Multi-year lows. CHK, multi-year lows. All of the commodity stocks. Another stock we look at, Mosaic, again, they're trading at multi-year lows again. Just on people are getting out of all these names. I guess into the end of the year, could be tax selling. As commodity prices keep going down and everything related to them continue to go down. That's a big part of the market, and it's keeping basically what's kept the market up. Apple, which is down, 20% from the highs at least. Amazon was kind of leading things. It's cooled off. Google has been leading things. It's up today, but it's not near its highs. Microsoft has been another leader, close to its highs. Again, Netflix up there as well. So some of the stocks that have been doing well are still doing okay, but all the other stocks that have done poorly are continuing to do poorly. And that's kind of the bottom line of all the underperforming stocks. So is any of that going to change? I don't know. I mean, this rally is petering out fast. And it wouldn't surprise me, because of the weakness in commodities, that everything else gets dragged down. All right. So if you've been long volatility, it was probably a good time to lighten some of it up. Is it time to go net short it? I don't think so. Okay. Because whatever's been causing sort of the dislocation into the end of last week has not sort of come out of the closet, so to speak, this week. The only thing I will say is we have slightly different term structure picture. I mean, this is, again, just ticking the last few seconds, right? So you're getting to just slightly back into contango again, meaning, right, the market, we had a little sell-off in VIX, and all of a sudden now the market is no longer expecting implied volatility to drop. Okay? Earlier this morning, right, it looked like, or yesterday, Friday, we had that VIX printed relatively high. You had a little back off. We had the weekend effect. And even with the weekend effect, volatile VIX is down. And now you're seeing, right, you've had the term structure flip-flop. All of a sudden now we are at least back into some kind of contango. So the market is no longer expecting VIX to make any radical drops anytime soon. The easy potential of post-Fed looks like it's gone away. And the pull of commodities are continuing to pull everything lower. We're going to adjust many things on that front because of that. Right. I don't expect that to change. I think volatility is, at least right now, fairly priced at the higher level. It's not too expensive, and I don't think it's too cheap. So trades have to be kind of, you're thinking maybe a long-term drop in vol, certainly possible, or maybe the market doesn't quite keep up with the volatility that we have now. Both are possible, but I think anything in the midterm is a tougher trade. All right, and with that, I will see all of you in our volatility, or our midday, our chat and our pit report later today. You all have a good day.